Well, all I can really say is this has been the moment we as investors have all been waiting for. Now, if you're sitting there saying, what exactly did I miss? I want you to listen up. This past week, the Federal Reserve held their latest FOMC meeting, which is where they discuss all the things that are important to you as a consumer concerning interest rates. And while Jerome Powell and the entire gang over there at the Federal Reserve didn't cut rates this go round, they cemented in the fact that inflation is sustainably dropping slowly but surely to their goal of 2%, which ultimately means that they're going to get closer and closer to having enough confidence to actually cut interest rates. But don't just take it from me as a financial YouTuber here, take it directly from the source.
As the labor market has cooled and inflation has declined, the risks to achieving our employment and inflation goals continue to move into better balance. Indeed, we're attentive to the risks to both sides of our dual mandate. We have stated that we do not expect it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. The second quarter's inflation readings have added to our confidence, and more good data would further strengthen that confidence. We will continue to make our decisions meeting by meeting. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we have seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment.
Now, September is really just right around the corner, and I mean weeks away, and a flash will be here, so just get ready to rally. At least that's exactly what the entire market is just anticipating with the first interest rate cut come the next meeting in September. And unless literally something goes spiraling out of control, which for goodness sake, it very well could, just considering over the last few years, we've expected something and gotten totally different results. The market is going to be the market. But as the market begins to take off, as it always does, it leaves investors asking a pretty good question of whether now is the right time to actually invest. And if you're asking that exact question, let me just shoot you straight. It is always time to invest, but you just have to position yourself well based on your age, investment timeline, and of course, your personal risk tolerance. And while focusing on businesses that have strong brand names, solid leadership teams, and clean balance sheets, you'll be set. Now, if that all sounds too challenging, well, just go with a broad market ETF that can never do you any wrong. But for those daring enough to swim into the high waters of the market, let's go ahead and kick off into our dividend list of the day. Up first, Amphenol, ticker symbol APH, which is an under-the-radar flying type of company producing electronic and fiber optic connectors and cables, which doesn't sound all that exciting, like say a chip player like NVIDIA, which by the way, NVIDIA is a customer of Amphenol. But I'm going to tell you this company is used in our everyday lives without us even knowing it. And that really makes me confident to invest into it as it's making our technological advanced world go round. However, after their slight pullback here from $70 per share down to $64 per share, it may be a time to actually look into the company as it performed very well year to date, up over 30% on the year. But zooming out, we're going to see spectacular performance where it delivered through on over 481% worth of appreciation. Bullishness coming in from the analysts with a forecasted share price coming back up to $73 per share, which is almost 15% worth of upside from here. Thanks to their sales orders coming in strong during Q2 that were up 33% year over year, along with their partnerships with all the AI related businesses out there. We're talking about a powerhouse. And moreover, the company helped increase their own value with share buybacks. Recently, you can see here a whopping $190 million purchase back in June. But get invested for the dividends here and over the long term, because we're talking about a dividend yield currently sitting at 1.03%, making for plenty of growth room there. And we're talking about growth that's averaging 19% year over year when it comes to that dividend over the last decade. And we're also talking about an 18-year track record. But if tech is, well, too hot for you right now, I get you, and I want you to go ahead and look into an industry that has been hit really hard. Heading into the restaurant industry, let's double down on Darden Restaurants, ticker symbol DRI. This is a dividend gem in my portfolio. It's a restaurant operator of some of America's top restaurant chains, talking about the Olive Garden, Longhorn Steakhouse, the fancier Eddie V's Seafood, and the Capitol Grill. Of course, as interest rates and inflation really created a double whammy impact on the company itself and restaurants across the board, well, Darden's share prices actually plummeted Unlimited here, we could see Darden trading at a marvelous discount for just $146 per share, PE ratio under 20 at 17.3. And you may think there's nothing too mouth-watering about a play like Darden, but I want you to go ahead and think again, because if we zoom out, we see over 363% worth of share price appreciation. Now, with rate cuts on the menu in the near future, analysts are bullishly expecting the share price to climb up to $169.32 per share. That's nearly 16% worth of upside from its current share price. And until then, well, the mouth-watering, juicy dividend that I have been enjoying since 2020 is coming in with a yield year at 3.83%, the whopping 23% growth rate average over the last 20 years. Now, if you're out there spending money like there is no tomorrow, whether you're wining and dining at some of Darden restaurants or you're out there just spending money, chances are you're not actually using cash, which brings me to Visa, ticker symbol V, a world leader in transaction facilitation, collecting fees from all the merchants when we as the consumers swipe our cards. Truly, in my opinion, a remarkable business model that has eliminated the risky element of lending by passing all the risk back to the banks who back the cards. Now, I actually want to go ahead and shout out this video sponsor, MOOMOO, and use their app to actually analyze Visa with all of you, as MOOMOO has really outdone themselves in providing comprehensive information for all of us investors when it comes to due diligence, but more recently dividend investors with drip options and specific dividend tools that I want to get into. But also MOOMOO has just become insanely simple to use in terms of analyzing data, making it easy for all of us to quickly get to the information that we need while keeping costs as low as possible on all trades, as stocks, ETFs, and options have zero commissions, while stock options, if that's your thing, actually have no contract fees with MOOMOO. Either way, let's tap into the app and pull up Visa, which as you can see has been in the green on the year, actually up nominally by over 2%. But if we toggle with the chart and zoom in, we can see that Visa has slid recently, likely from regulatory developments and revenue growth slowing down, while EPS targets are actually elevated risk due to consumer trend shifts. But let's just go ahead and see the dividend growth juggernaut's performance over the last 5 years. We're going to get nothing but sheer appreciation, up over 53% despite all of the consumer setbacks that we've been experiencing. Now, by clicking on the company tab, you can see that we get the company's valuation and PE ratio right there on the screen at 28.4, but be sure to compare that against the industry average, which helps determine the current share price, whether it's cheap or expensive compared to all the competitors out there. But we can also slide back up here to get our analyst ratings, which depicts bullishness from the analyst, targeting a share price hitting $310.82 per share. That's over 17% worth of upside from here. However, as dividend investors, let's just go ahead and use some of MOOMOO's latest dividend tools here by tapping on the dividend tab, where we can immediately see the current yield coming in small but mighty at 0.76%, with the payout ratio at just 21%, indicating how much net profit is actually distributed to all of us. And we can also see that the dividend growth curve here is making it easier than ever to track annual increases. Now, the dividend calendar lets us, of course, go ahead and see when we need to go ahead and buy more shares of Visa with that ex-dividend date coming up. Now, in MOOMOO's most exciting news recently, they now support DRIP, allowing dividends to be reinvested for compound interest. So as for Visa, in my book, it's a buy right now to enjoy over the course of decades to come if, well, we really don't change the game on how we spend. But one last MOOMOO tidbit here. Right now, MOOMOO is offering a limited time 8.1% APY via its cash sweep program to new users, meaning when you're not busy trading, the MOOMOO team is automatically calculating interest for you. And with that deposit into your account, we're talking about literally you can do nothing and still get money. If we are talking dividends, an 8.1% APY exceeds many high dividend stocks, so go figure there. But use MOOMOO simply to make money every single day, whether you're investing or just parking your money with them. Now, if you decide to run with MOOMOO, open up the account and deposit funds, and you can actually get up to 15 free stocks. Or if you decide to transfer your account, you can also collect up to $300 in cash rewards. Of course, terms and conditions always apply, but click the link in my pinned comment or in the description if you actually plan on opening up an account with MOOMOO, because heck, it's a win-win for the both of us. Now, with all of that being said, let's keep this show on the road and get going here with Waste Management, ticker symbol WM, to which I'm always sharing that one man's trash is truly another man's treasure. And that is especially the case when it comes to waste management. after it slid from about a week ago from $223 per share down to $202 per share. Now, the last it dropped by this much, I said to buy it and hold it. And I'm here saying it again simply because we have a rich history depicting appreciation of over 461% over the last decade, which makes a lot of sense considering they're basically a monopoly within the waste management industry. Analysts agree with me here with almost 11% worth of upside expected, coming up to $223.92 per share, while smart money has been pouring millions of dollars into the company buying more shares. But it's the dividend opportunity that gets me here with waste management, that yield coming in at a low of 1.48%, meaning ton of growth ahead of it with 24 years worth of a track record. But get this, a 33% rate worth of growth over the last 2 decades. Next, let's go ahead and talk about Caterpillar, ticker symbol CAT. It's the construction industry leader when it comes to construction engines and machinery that has been able to stretch its global footprint really just all around the world as a dominant player. Yet as economic conditions have truly set back the construction industry as a whole and of itself, the company hasn't had the easiest time. But I continue to look forward to interest rate cuts, whereas we would then see DIY projects pick up and overall construction projects back on the mend. As a matter of fact, as we've been flirting with the idea all year long, Caterpillar has performed quite well, up over 18% on the year, trading for $346 per share. PE ratio still down here at 15.4, but zooming out, we see over 347% worth of appreciation over the last decade. As for analysts, they're optimistic as well, over 9.2% worth of upside expected. That results in a share price hitting $378.33 per share. And until then, you're going to enjoy a 1.63% dividend yield that's been steadily growing now by about 10% year over year while maintaining a great track record of 31 years. Now, as for the one dividend stock that I am actually personally very bullish on, it may take some of you by surprise, but it is in fact Canadian National Railway, ticker symbol CNI, which is actually Canada's largest railway company in terms of both revenue and physical size of their rail network that stretches all the way down to the south of the United States. But take advantage of the opportunity right now, especially when a play like Canadian National is down by almost 7%, trading for $115 per share. PE ratio also below 20 at 18.5. Now, if we zoom out, we're going to see over 109% worth of share price appreciation, but the most important indicators here stem from the insiders themselves, who have been buying back shares as recently as July 27th at the executive level with over $500,000 purchase made, all while smart money has been loading up on the stock as well. And to top it all off, analysts have only been bullish on Canadian Rail, talking about a forecasted share price hitting $132.29. That's over 14% worth of upside from here. But we don't have to wait to collect on our profits thanks to the dividend yield that comes in at 2.12%, which has been paid out now for the last 27 years while growing all along the way by 16% year over year. Now, investors, there you have them, all 6 dividend stock opportunities ripe for your investment. But now I gotta know your thoughts on all of these dividend stocks, if you have them in your portfolio or if you have better dividend stock picks in mind, or what exactly you're going to be investing into when interest rate cuts finally hit. Drop all of your thoughts down in the comment below. Be sure you're subscribed, and of course, I'm going to make this easy for you. You can just tune into more insights right here.